Scouring the international market for investments? If you're ready to buy an overseas property, know your tax implications before it's too late. Aussie property investors are looking to sink their teeth into overseas investments, but without an understanding of tax obligations, these opportunities can quickly land you in hot water. Hey everyone, it's Kim Koch from Geotax, here with another video designed to help you become a smarter property investor. As we speak, property prices in Australia are hitting record-breaking levels. The market has never been more inundated and competitive, and these dramatic price increases are wreaking havoc on investors looking to get their foot in the door. So, there's no surprise that investors are turning to opportunities in overseas real estate markets instead, especially where properties may be slightly undervalued. Sounds like the perfect alternative, right? Not quite. Even if you hold real estate assets outside of Australia, you're still required to notify the Australian Taxation Office of your investment in your tax return. Failing to do so means you can potentially land yourself in the bad books with the ATO and lose out on your big investments. Luckily, by following the rulebook and doing your due diligence where it's needed, you'll avoid these risks. And in today's video, we will fill you in on everything you need to know to keep your overseas investments out of hot water. Stay tuned! But before we start, we want to be clear that this video is for informational purpose. In no way should you interpret this as a financial or tax advice. We always recommend working with a qualified financial advisor or tax agent to give you the best advice for your situation. Okay, let's jump right in. If you are an Australian resident, any income you earn outside of Australia is considered assessable income and must be declared in your income tax return. This is the same rule you'd follow if you were earning an income from a property in Australia. Plus, you will also have to declare any capital gain or losses if you sell these overseas properties. And in case you think the ATO can't track your cash flow movement in and out of Australia, think again. There's no pulling the wool over these guys, and even attempting to is a massive risk to take. More than ever before, the ATO is becoming increasingly sophisticated, equipped with data matching technology and mutual agreements with other countries to share data. There's no escaping the obligations you carry as an investor in Australia, or even as an owner of any form of business. If you're caught out, you could face pretty hefty penalties, including jail time. Not worth it, right? Aside from Australian obligations, you may also be required to pay tax in the country you bought your investment property in. Thankfully, Australia has entered several tax treaties and agreements with other countries to address double taxation. But as a general rule of thumb, both Australia and the country where your property is located may have tax rights over the rental income, so you'll need to do your homework first. That's where speaking to a financial advisor is the best first step to take. Basically, if Australia has entered into a double taxation agreement with another country that plays home to your property, you can generally avoid being double taxed under the foreign income tax offset system. Under this system, the ATO will provide you with an income tax offset to reduce the Australian tax payable on the rental income if tax has already been paid elsewhere on the same income. But there are, of course, limits to what you can claim. The offset amount you're entitled to will not always be the same as the amount of tax you paid overseas. If you're claiming more than 1,000 Australian dollars, you will need to complete the FITO limit calculation to establish what you are entitled to claim. The calculation is quite complex, so you'll need to speak to a tax agent about how much your offset would be if your foreign tax amount is more than $1,000. You will also need to verify what the double taxation agreement is. In certain limited circumstances, the country where you own the investment property might have exclusive tax rights over the rental income, which means that income may not even be accessible in Australia. While all these complicated rules may seem tedious to wade through, it's important that you do your homework on what the double tax agreements say about your circumstances. Understanding how you are impacted is crucial for your tax obligations in Australia. Let's assume you had to pay tax in Australia. As an example, Can you claim investment property tax deductions in Australia for an overseas investment? The short answer is yes. If you incur any expenses related to the cost of maintaining your overseas investment property, you can claim a 100% tax deduction in Australia against the rental income. The only time you won't be allowed to claim the expense is if the cost is associated with the improvement of the property. This is when you would need to organise a depreciation schedule. This means that you can't claim the cost of improving or replacing something on or within the overseas property, but you can claim this on depreciation or building allowance over the property's lifetime. In a nutshell, you can claim repair and maintenance expenses, property management fees, insurance, and tax depreciation. By the way, if you would like to know more about these deductions and how you can get more from your tax return, make sure you check out our video that specifically breaks down each relevant deduction. We even show you how you can claim them. But remember, these cases all relate only to tax legislations in Australia. You'll need to speak to a tax agent in the country where your overseas property is located about your tax implications and what deductions you can claim there. The last two things I want to talk about are capital gains tax and negative gearing. How you treat capital gains tax is determined by the double taxation agreement between Australia and the country where you bought your investment property, just like with income tax. For example, the agreement might provide exclusive taxing rights to one country or allow both countries to tax the capital gain. And in other circumstances, the foreign jurisdiction may not have a capital gains tax regime at all. But generally, unless the agreement specifically excludes Australia from taxing the capital gain, the normal CGT rules in Australia will apply. If foreign tax has also been paid on the capital gain, using the FITO system will avoid double taxation. Speaking of negative gearing, property investors can offset a loss from their overseas property against their annual income, including all income generated in Australia. But this is, once again, a relatively complex topic, so you'll need to seek professional advice from a registered tax agent or financial consultant. So there you have it. You're well on your way to understanding the basics of overseas property investments and tax obligations in Australia. If you found this video helpful, make sure you hit like and subscribe to our channel for more property investment tips. I'm Kim Quach from Geotax. See you next time.